Good afternoon, everyone, and welcome to our webcast, the Ppp Flexibility Act of 2020. What are your options now? For those of you who I've not yet met, I'm Dan Meyer, publisher of BizTimes Media. Today's webcast is presented by BT360, the content studio arm of BizTimes Media. On behalf of BT360, BizTimes and our sponsors, Davis & Kuelthau, First Midwest Bank, and Sikich, thank you for attending. What does this new Ppp Flexibility Act of 2020 mean for your business? The act may be relatively straightforward, but for many, the decision process is not. And the options have been expanded since you applied for the loan back in April and May. Will the act benefit your business, and how do the new rules apply to you? Our presenters will provide their perspectives and address the new rules and factors to consider when evaluating how best to maximize your loan forgiveness, as well as the next steps and timing. They will address reasons to opt for the 24-week extension, accounting ramifications of choosing 8 weeks or 24 weeks, staffing issues to consider, the pros and cons of opting to comply with the modified 60-40 rule versus the original 75-25 rule, the optimal time frame to apply for forgiveness, and what planning is needed now, and getting the forgiveness application right the first time. The slide deck will be available after you fill out the attendee survey at the conclusion. Before we begin, on behalf of BizTimes Media, I'd like to thank you for your readership support and for your print and digital advertising support and event sponsorships. This is our 25th year as an independent, family-owned business, and we're the only locally owned business media company in the region. However, to serve this community for the next 25 years, we'll continue to need your marketing and advertising support now more than ever. I guarantee that we'll work hard every day to earn your business and to help you grow your business through our custom and integrated marketing programs. If you're interested, please contact our sales director, Linda Crawford. In addition, our award-winning editorial team is always looking for story ideas, especially forward-looking operational insight stories that can help our readers make more informed decisions in running their company or insights on how to be better business leaders themselves. And yesterday, we launched our Insider Subscriber Program. For $8 a month, you can be an insider and receive several insider benefits, including access to all the content produced by our editorial team. It's also your opportunity to support local journalism. Before I introduce the presenters, I want to mention that today's webcast is being recorded and will be available on demand later today on our website. And upon conclusion of the program, please fill out the attendee survey to access the slide deck. So now on to the presenters. When I introduce you, please give a quick shout out to everybody. Our presenters are Jerry Schlitz, Senior Vice President, Commercial Banking Manager with First Midwest Bank. Welcome, Jerry.
Good afternoon.
There's Larry Glussman, Commercial Finance and Corporate Attorney with Davis & Kuelthau. Hello, Larry.
Hello, everyone. It's good to be here again. Thank you.
Yeah, thanks, Larry. And Ray Lampner, partner with Sikich. Hey, Ray.
Hello. Thanks for letting us present to you guys today.
Looking forward to it. So during the presentations and discussion, please submit any questions you have by using the Q&A feature. There were many questions submitted beforehand, and we're going to try to really get to as many of these as possible. So we're pleased to have Jerry Schlitz kick things off by providing us with an overview of the PPP program. As I mentioned, Jerry is Senior Vice President, Commercial Banking Manager at First Midwest Bank here in Milwaukee. The First Midwest Bank logo may be new to some of you on this webcast. That's because over the weekend and effective yesterday, Monday, June 15th, Park Bank Milwaukee, which has served the southeastern Wisconsin market for over 105 years, successfully transitioned into First Midwest Bank. So Jerry, I'm going to turn it over to you.
Thank you. Yeah.
Take on your slides. Thanks, Jerry.
Thank you. Yesterday was for us, again, as Dan mentioned, we switched over from Park Bank to First Midwest Bank. We're pleased to be part of the First Midwest Bank. Park Bank has got a great team of local and experienced bankers.
We were having this audio
And
issue.
will now have the capacity. First Midwest is now able to be part of that family and moving forward. Technical difficulty, so bear with me if that's the case. Let's start with a quick overview of the program. I think it's important to understand how we got to this point in time. The Payment Protection Program really was a historic program in both volume and purpose. More than 4.6 million loans were pushed out through the banking industry with just over a couple of months. More than $510 billion was pushed into the business communities to help offset the impact of the COVID situation. So a lot of good effort was put forth, and a lot of companies were really assisted through this program. There is funds still available. Early on, the funds ran out very quickly in the first two tranches, the first tranche, but the second tranche has been able to hold up, and it looks like there's about $130 billion left to be dispersed. Generally speaking, the loans right now are getting smaller in nature. The average up until this point was about $112,000 average. They've just ranged from over a couple thousand to over $10 million. So we've seen a pretty wide volume of, or wide range of loans being produced. It's really nothing like I've ever seen in my 30-year career. The volumes were tremendous, put a real strain on not only the borrowers and understand the program, but the banks and the SBA. So a lot of volume to be gone. Continues to change forward through the forgiveness process. That the all demands on the system is relatively high. Next slide. For the role of the SBA. This program is really unique to the SBA. Typically, the SBA has provided loans for growth that are meant to be repaid. The PPP loans are really designed to be forgiven, and the new guidance that has come out in the Flexibility Act reinforces that initiative. It's really made it as easy as possible to have these loans go for payroll or other expenses to offset the impact of the COVID situation. So overall, the program has been developed, designed to be forgiven, but it has been designed kind of on the fly. So it has created lots of changes to the program, and as we know, even today, we're still waiting for more guidance to come out on the forgiveness process. The SBA will be providing final say on the forgiveness. The forgiveness decision could take up to 90 days for the SBA to determine once they get the package from the bank. So it's important to keep that 3-month period in mind as you move towards presenting your application for forgiveness. Why don't we go to the next slide? Next slide, please.
The role of the bank.
Yes, thank you. The bank here is really acting as a facilitator. In the past, for SBA loans, the bank really acted as an underwriter, making sure that information was provided that would show that these loans would be repaid. Again, this is completely different given the volumes here. The bank is really acting faith review of the doctor that the application is appropriate to the borrower. The bank has 60 days to review the application and make sure it's complete before forwarding on to the SBA. And again, it has to be a complete application before the 60-day window is available. So it's important to make sure your application is complete when you provide it to the banks and move through the review function as quickly as possible. And obviously we would forward the application on to BA for a decision on the forgiveness. Next slide, please. Can I get the role of the borrower?
Right, it's just a little lag with the technology.
Okay,
So the role of the borrower is up there now.
thank you. The role of the borrower really comes down to a few main things. And first of all, making sure you have enough records and receipts to support your forgiveness application. It's really critical to make sure you've gathered all the documentation from a payroll and rent and other expenses active so you can support the application as it is presented to the bank and the SBA. As I mentioned before, the obligation as from the borrower standpoint is to really stay on top of the different guidance that's coming from the SBA on the program. You know, the program has been in constant change in terms of the guidance, so you need to stay on top of the additional guidance that will be forthcoming on the forgiveness process. The borrower will need to attest that all the documentation is accurate and that it was done in good faith as the program has been rolled out. You need to consult with your tax, legal, and accounting advisors for the final risk calculation. Make sure you run it past your advisors as best as possible to make sure that that you're able to provide a complete image and it's as accurate as possible so it doesn't get kicked back out of the system during the forgiveness process. And then again, as we mentioned, just submit a complete application. It will help in the process and the speed of your forgiveness decision. With that, let's move into an overview of the Flexibility Act.
It's there, it's just slow on your end, Jerry.
Okay, sorry about that.
No.
The Flexibility Act, there's been a few changes that'll start in, and Ray and Larry can move into the more specifics. But the deferral period moved from 6 to 10 months. This is really important because, as I mentioned, the bank has up to 2 months to move the application to the SBA. The SBA has up to 3 months, so there's a 5-month period that the application decision process it might take to get done. So that 10-month period accounts for the process that happens after the application has been provided to the bank. The loan maturity has changed from 2 to 5 years. Anybody who received a loan after June 5th, the maturity is a 5-year window already. Those loans that were provided earlier than June 5th, which accounts for most of them, you're currently under a 2-year maturity in terms of the documentation you've signed. There is an option to go to a 5-year repayment on anything that's not forgiven, but that is only provided under a mutually agreed upon a decision by the borrower and the bank. We're waiting for guidance on how that process will work. You know, how those get converted from a 2 to 5 year if there's not forgiveness on those principal dollars. And then they'll have a 1% interest rate. Amortization will start on any funds that are not forgiven after forgiveness decision is made or at the 10-month period, whichever comes first. And then a couple of final, excuse me.
Yeah, it's there. It's just slow.
A couple of final thoughts.
The important notes slide is up.
Mentioned to be so the additional guidance that's being from the be numerous. They have been numerous up until this point, so stay on top of those. And then just a last little disclaimer from First Midwest that the bank really isn't there to provide tax or legal or accounting advice, you need to talk with your advisors about that. So with that, I would pass this over to Ray in terms of more detail of forgiveness.
Thanks, Jerry. As a reminder, we'll get through this technology internet issue, but please submit your questions on the Q&A feature. The recording and the slides are available after the program. Next up is Ray Lampner, partner with Sikich, and Larry Glussman, a corporate attorney with Davis & Kuelthau. They'll cover the next portion of the program. Ray, I'll turn it over to you.
Great, thank you very much. So Larry and I will kind of be going through this together. The first part that I'm going to talk about is we're calling it a refresher, the PPP. And something to keep in mind, obviously the bill got passed about a week and a half ago, and there's some really good stuff in there. But on this refresher, even if you sat through some of our other seminars, I suggest you listen in, because some of the stuff in here is actually updates from when the loan forgiveness application came out. And so even though it's titled kind of refresher, it might have some new information for you. So I definitely suggest you listen in if you have not read the application yet again. So just as a refresher, it was passed into law in March of 2020. People shortly took after that, got loans out quickly after that. And so we actually have several people, if they're not there already, are actually getting to the end of the 8-week period and actually looking at applying for loan forgiveness. Meant to cover lease payments, interest, and mortgage utilities, mortgage interest. Potentially could have forgiveness at the end of the 8-week period, which you'll hear later on if that has changed. But some of the issues are coming forward, and we saw with our own clients that we've been working with and people we've been talking to, is that most people were not going to see full forgiveness. And I think the intent of when this came out was to give people full forgiveness, and that's what's led to the Flexibility Act we had gone through. We can go ahead and go to the next slide. Okay, so just as a reminder, and again, some of this is we're going to talk about was actually came out with the application, which has only been out for about 2 weeks, is, what kind of expenses are forgivable in this period. One of them is salaries. And so salaries includes, severance, vacation pay, all those different types of things are included in salary. And there is a cap of $100,000 for those salary amounts. It's going to be prorated later, I'll talk about a little bit later. But the one thing that came out in the application is with owners. And so we saw some owners that maybe took out lower salary in 2019 were actually bumping up their salaries in 2020 during the 8-week period in order to get more forgiveness. And then when the application came out, they changed it for owners that it's the lower of that $100,000 annualized number or an annualized number of the 2019 salary. So if that's something you were doing, it's not going to do you much good anymore. I know I did talk to one business owner about this recently, and what we kind of talked about doing is, first thing out of their mouth was, maybe I just stopped taking a paycheck for a while in order to do this. And I said, well, you might run into like a full-time equivalency issue. So they're going to continue to pay themselves something so the owner can be considered an FTE during this process. So, just take that into consideration if that's something you've done. Employee benefits are included in there as far as, and these are not subject to the $100,000 limit. So that's going to be health benefits, vision, dental, again, the employer paid portion of that. And I know we talked about in the last webinar, but this would also include things like ESOP contributions and that type of stuff. And then again, for sole proprietors, they're not going to be looking at the 2020 income and prorating that for that. Really, it's going back to the 2019. And if you're doing the 8 weeks, it's 850 seconds. And then again, if it's 24 weeks, maybe it's 2450 seconds. So if that's the change and you're sole proprietor, you had no employees, and it was just based upon your income, looking at that, you're probably looking at getting full forgiveness on the loan. And one thing that also they changed on this, when the original rules came out on expenses, it must be paid and incurred. They have changed it to be paid or incurred. And I've got an example in a couple slides of how to kind of look through that. But the costs must be paid or incurred before the next regular payroll date. So when it comes to payroll, you still have to follow your normal payroll procedures and the timing of it, but it can't fall outside that 8-week period. If I'm going to switch the slide. So this is something that came out with the application. So one of the questions we got a lot from was, I got my loan my loan was funded on May 1st, so therefore my covered period started on May 1st. Just as a reminder, that's when your covered period starts. It's the date you receive money from the bank. It actually gets deposited in your account. And I got a payroll that finishes on, May 3rd. Does that payroll count? How does it work? And before this, the loan application was done, we were telling everybody, well, if you paid it May 3rd, then yeah, that's going to count, and you're going to whatever you pay that 8-week period. This allows you to take a different approach. So you can still do kind of what we had talked about, but this allows you to say, okay, I got my covered period starts on May 1st. My next payroll starts on May 10th. So you can actually take that May 10th period and have that beginning your payroll period. Now what happens there is it ends up going beyond the 8-week period. And so as long as you're paying it when you're normally supposed to, it's okay to go ahead and do that. So that's something to look at. And what we're telling everybody is run it both ways, see what makes the most sense for you in this process. You have the option. You don't have to elect it now, all those kinds of things. So just as you're going through it, go ahead and just run numbers both ways and see what's better for you. Because we had a lot of people that at the beginning, they hadn't brought people back yet. And so the first payroll under the old method was going to be light because of that. So this allows you to kind of get rid of a light payroll and put in a full payroll later on. Do you want to go ahead and to the next slide? So non-payroll costs, you go through. So other things that count. So rent on real estate and personal property. Couple rules there is it can be related parties. So if you're renting a building from the same owner, it's just in a different entity, you can still do that. The rules are going to be, had to be in place before February 15th, the contract that you're using, and it must be at fair market rent. So you can do that. The piece on the rent to keep in mind is that it's not just rent on building, it's rent on equipment, vehicles, that type of stuff. We're seeing construction companies look at, renting equipment for jobs and stuff like that. That's all something that would fit into that category. So when you're looking at that, just keep in mind that it's not just rent on a building. Utilities, it's the normal gas, electric, all those kinds of things that you would put in there. The one thing that we get a lot of questions on is transportation. What does transportation mean? And the definitions that we're working with right now are basically fuel. So if you have trucks, if you have cars, those types of things, the fuel that you're putting into the vehicles are what would fit under transportation costs. And then interest on mortgage and debt obligations secured by real property, by real or personal property. So this is one, I'm seeing a lot of back and forth on this one on really how it's being interpreted. There's times that I see basically if it's I've seen people take the approach of, well, if it's a line of credit backed by personal property or substantially all the assets of the company, then that would work. And I've seen some other people say that doesn't. So I think this is something we're still waiting on guidance, which makes it tough. But then now that we've got this 24-week period, that stuff may not be as important as it was. And I mentioned before that they changed it from expenses that must be paid or incurred to where it was paid and incurred, now it's paid or incurred. And it kind of opens things up. And this was something that came up when 8 weeks was still kind of the rule. You didn't have the 24-week option. April, this example is a utility bill. So, let's just go with the fact that, the cover period starts May 1st when you go through this. Well, in May, are you paying your electric bill for April? So it was paid in the 8-week period. So you pay your May bill and your April bill in May, you pay your May bill in June, and then your June bill, as long as you're paid by the normal due date in July, that counts also. So based upon the rules that are in place now, you could have 3 months of utility bills in an 8-week period when it falls through. So again, I'm not sure if that's something that was intended to be done when they changed it, but again, this is something that changed on the loan application. We had been telling people, 8 weeks of expenses in an 8-week period, but based upon this reading of it, it could open a door a little bit. We'll go to the next slide. Okay, so here's another one. Like, I know we talked a lot about the reduction in full-time equivalents last time and stuff like that, but this is something that, again, they changed it a little bit up when they put out the loan application. still the overall computation is still the same, and I'm going to assume an 8-week period, basically because the rules for the 24 on this haven't really come out. We're assuming it gets extended to 24 weeks, but who knows? And so really you're looking at a base period. The 2 base periods are listed there. It's February 15th of 2019 and June 30th, 2019, or you're looking at January 1st, 2020 through February 29th, 2020. And you really have, it's one of those things, run numbers both ways, see what's best for you. And so you're looking at your average employee full-time equivalents during the cover period, comparing them to the base. And if you're down, you have to take a reduction in your loan forgiveness. And when you're looking at this, so the big question is, how do you compute the full-time equivalents? Well, when the application came out, they did say it's 40 hours. There were a lot of people saying before, is a 30-hour person considered full-time or not? They did come out and say it's 40-hour work week is how they compute it. The other thing they did is, again, they gave you another option, the way they compute it. So they have a regular and a simplified way of going about it. A regular means you're rounding everybody off to 0.1. So if somebody works 4 hours out of 40 hours, they're 0.1. 8 hours out of 40 hours is 0.2. They also have what's called a simplified method. This is basically everybody less than full-time would be considered 0.5, half, when you go through and do this. And again, you have the option of doing either one. So again, run the numbers, see what's best for you when you do it. But something to keep in mind with that is, I saw somebody have an article the other day that said, well, if you're allowed to do that, what's stopping you from hiring 40 people working 1 hour a week? Now all of a sudden you have 20 full-time equivalents. I'm sure that's not what they were expecting. I'm not sure if you can get it through, but if you read the rules, yeah, I'm sure that it does sound like that would work, but I'm not sure that's the intent of what they were trying to get at. But when you go through. And the other reduction was if you reduce somebody's compensation by more than 25%. Now, this would just be for people that were making less than $100,000 a year. And again, it's 25% of their actual compensation, their rate. And so the example I use is if you had somebody working 60 hours a week, getting 20 hours of overtime, let's just say their base was $10 an hour. Got $15 an hour during with overtime. If they go to 40 hours a week, they're obviously going to have more than a 25% decrease in total compensation, but if their rate's still $10 an hour, they do not get dinged for the second step. So just make sure you keep that in mind. It's not a total compensation, it's the rate. So in that case, you could actually take the $10 person, knock them down to $7.50 an hour, and you still wouldn't have an issue when you do that. And then there was, for the 8-week period, there was an exception for that. If you restored you stored the wage rates and your full-time equivalents by June 30th, that the decreases for the reduction in full-time equivalents and wages would be restored. They changed that on the new one for the 24-week to December 31st, 2020. All right, and I think at this point, Larry, I get to turn it over to you.
Great, thanks, Ray. This is Larry Glussman. Thanks again for folks for being here today. I'm going to take us through the actual Flexibility Act, which is about a 10-day-old law, and some further clarifications that Congress has made, or that the SBA has made since then. So as this slide points out, Congress has been busy helping folks out. The Paycheck Protection Program Flexibility Act of 2020, the PPRA, or the Flexibility Act, passed the Senate on June 3rd, and then the President signed it on the 5th. There had been a couple competing versions in the House and the Senate of other extension bills that would have had some different features in them, but this is what we got, and it still provides plenty of flexibility, so we'll take it and be happy. So at the bottom here, I'm pointing out that there are 2 different interim final rule additional revisions that have come out so far on June 11th and 12th. And we'll talk about the major implications of those a little bit further in the presentation. So next slide, please. Thank you. So the Flexibility Act, the principal thing that it did, as we've been talking about, is it moved the covered period definition either for new borrowers after the act or borrowers before that still have any time left in their covered period. They have the choice to go from 8 to 24 weeks. And folks afterwards, they just have the option of the 24-week covered period. So folks like restaurants, or other folks were lobbying for as long a period of time as possible, because as you've seen, it's taken folks quite a while to get back open, and they wanted to have the ability to use as much of this money as possible. Essentially, the 24 weeks runs just like the 8 did from the date of the loan origination, and then the end of the program piece essentially is December 31st, 2020. So that's essentially the old June 30th date. So they pushed it back 6 months. There is as we've been talking about, the longer covered period should result in more forgiveness for more folks, because whereas Ray and I, and I'm sure the bank have seen an other accountants and bankers and lawyers and other consultants have looked at a variety of different strategies that people were using to employ or looking to employ to try to spend the money creatively if they weren't able to get it all fit, or to try to fit it all in within the 8-week period. So what this is going to let folks do principally is spend it on categories that are not going to be any problem from a forgivability perspective, at least on the front side. There could be a reduction issue on the back side, but in terms of the actual expenditures themselves, this should make things easier, and in general, more portions of loans forgivable. There is a note here about, and Ray mentioned this before, that the prior cap of 15,385 could, given the longer period of time, the 24 weeks, could now be a much higher cap of just over 46,000. And again, the common refrain today, as last time, is we're still waiting for further guidance on that. In our discussions and preparations for this, folks have been talking about the fact that there may be a list of FAQs that the SBA has and has just been tweaking or ready to drop that could be, 30 or so questions. So there likely will be a lot of answers relatively quickly. But since folks have a longer period of time, at least if they're in the 24-week period or select it, you can wait for that guidance to follow. We certainly will have folks on the webinar today that are right up against the deadline. And so as we move forward, you'll want to consider whether it makes sense to spill into the 24-week period. It's an either or. It's either 8 or 24. Obviously, folks are going to spend their money quicker than 24 weeks. Most folks will. So essentially, under the 8-week plan, you would be obligated to maintain your FTE levels and also your employment compensation levels through June 30th only. If you move over to the 24-week period, you're going to open yourself up at an outside date to having to get those levels back to where they were by December 31st. We're hoping that there's some middle ground that's established that is roughly concurrent with the time that you use your money up. But for now, we don't have any further guidance on that. So December 31st for this purpose is the old June 30th.
Hey, Larry, can I just say something?
That's right.
So one thing we've been telling people is with this either 8-week or 24-week time period, there's no requirement you need to make that decision right now. So just because you get to the end of the 8-week period doesn't mean you need to rush in and do the loan forgiveness application. You can wait, and there's no time period of when you have to file the 8 weeks other than 10 months after the loan. So you can wait to see how the 24-week period shakes out. You can wait to see what the new guidance is that comes out. So, just so people know that, you're not forced to do something in these last couple of weeks. You can wait and see which one works out better for you and file at that time.
Thanks, Ray. So essentially what that would mean is if you've got money that you can't spend within the 8 weeks, and don't want to try to use any sort of aggressive strategy to try to spend, you can hold it and you would either give it back to the SBA, or if you elect the 24-week period, then you can use it during that period of time. There is a question that'll be coming up later. I can just answer it now. Folks want to know whether you have to opt in any way to the 24 weeks, and as Ray was alluding to, you don't. You just keep moving. Next slide, please. So again, this was covered before during Jerry's piece, but previously, despite the statute saying there were supposed to be 10-year terms, Treasury said 2 years was enough. So all loans made before June 5th have a 2-year term. Anything from the Flexibility Act forward in time now has a 5-year term. And then again, you can approach your lender. The SBA specifically says to see if they're interested in giving you up to the 5-year term if you are a pre-existing borrower at the time the Flexibility Act came about. And then the Act also, and importantly, takes from 6 months the period of time that you had payment deferrals, and it extends that to the date that you receive notice of forgiveness or 10 months after the close of the 24-week period. I'm saying, or October 31st, 2020, whichever comes first. So essentially, if you don't apply for forgiveness within the 10-month window when you're supposed to, at the close of that period of time, payments start to become due. So it could be quite a while if you're looking to just turn this into a loan before you have to make any payments at all. And again, interest is accruing, but payments are not required to be made. Next slide, please. All right, so the old 75-25 rule, which required that you spend no more than 25% on non-payroll expenses, has now been replaced by the 60-40 rule. So again, and I guess I should point out at the bottom here, there were 2 sets of clarifications as to what this meant, because there was some theory that this created a cliff, so that if you spent anything less than 60% of the loan proceeds on payroll expenses, that you would you'd not be eligible for forgiveness at all. So SBA and Treasury issued a statement on the 8th, and on the 11th, this first revision to the first interim final rules clarified, as we say here, that there's a proportional limit on non-payroll costs rather than a threshold for recognizing any forgiveness. So that was something that got cleaned up very quickly, scared a lot of people, but not for a very long period of time. Next slide, please. Okay. So again, this is what we were alluding to before, the issue of the safe harbor. So if you spend everything appropriately during this period of time, and you don't reduce your FTE count, and you don't reduce your salaries, or at least you're able to restore them by what was prior June 30th and now is probably December 31st, then the loan is forgivable. If you wind up coming in below those numbers, then there's a proportionate reduction in the forgiveness. And again, this is what Ray was talking about before. So there's really no change to that concept. Although, as you'll see, there are going to be there are some additional safe harbor exceptions that folks will be able to take advantage of that should do more to ensure that more folks wind up attaining forgiveness. Next slide, please. Okay, so these are the couple things that are new in the Flexibility Act. So we're gonna, in the next slide, once we get there, you'll see we'll aggregate these from what we already know. But the new stuff is this inability to rehire individuals that were employed on February 15th, which has always been a magic date. And then the inability to hire similarly qualified employees for those unfilled positions by December 31st. And then the second category really is, essentially the COVID-related piece. So the inability to return to the same level of business activity as you had on February 15th, again, the original magic date. Now you have the ability, because folks are worried about starting up and then having to stop again, we saw inside and outside, as we've been seeing. This provides I think, a pretty large measure of comfort that if you're shut down again, that's not going to be held against you. And it's not going to jeopardize the forgivability of what you've already been able to spend or what you're able to spend once you reopen for the second time. The clarify, we're hoping, well, we expect there'll be some clarification, because the way it reads is it's either whatever CDC guidelines are out there that might impact your business, Department of Health and Human Services guidelines, and also whatever OSHA might establish. So it remains to be seen if, well, we presume that whatever, all this stuff is being determined essentially at the most local government level. So whether it's health inspector, whether it's the mayor, whether it's a county executive or otherwise, presumably they'll be acting on advice from one or all of those entities at the federal level. And so, it would be, there could be a little bit of a trap here if the feds say you should close, but the local folks say things are okay to stay open. But again, we'll cross that bridge when we come to it. Next slide. So this is just a summary of all the items that came both from the forgiveness application and also from the Flexibility Act that could create a safe harbor for you and provide exemptions from forgivability deductions. You can read the list as well as I can, but for cause firings, voluntary resignations are still covered. An employee who voluntarily requests in writing and receives a reduction in their hours doesn't count against you. We saw this in one of the rules. There's a process for offering in writing to rehire the employee, but that the employee refuses the offer. So again, also needs to be in writing, and that's laid out very clearly in the rules. And then what we just talked about, the inability to rehire or hire similarly qualified folks or COVID-related forced closings. Okay, so the interim final rules on the 11th and 12th updated the certifications, and the thing that I want to call your attention to most notably is that if funds are knowingly used for unauthorized purposes, you may be legally liable for such charges as for fraud. So the government just wants to reiterate that it wants these funds spent on what are presumed to be allowable covered expenses. And you should certainly steer away from things that are clearly not even close to those categories of expense, or you're taking your chances. And then the most recent piece has to do with folks, with owners who of 20% or more of the business who have any sort of felony in their background. The old rule was any felony within the last 5 years. That's been made more flexible to anyone, to any topic that's on this list. If you're currently incarcerated, on probation or parole, subject to some form of indictment or formal charge, have been convicted of a fraud, bribery, embezzlement, or false statement felony within the last 5 years, or convicted of any other felony within the last year. So a liberalization of that to open this up to more categories of business owners. And we're going to turn this back over to Ray at this point to talk a little bit about payroll taxes.
Okay, thanks, Larry. So one of the things that under the before this act was passed, there was an issue with is that part of the original CARES Act had a payroll tax deferral, specifically the 6.2% the employer paid Social Security, and when it came out, basically they had said that if you get a PPP loan, you can't use it. Then there was some further guidance that came out and said, well, you can start deferring the payroll taxes once you have your loan forgiveness figured out. They have now come out and said you're allowed to do it. So you'll see down below, you can do the payroll tax deferral to 6.2% through the end of the year, and then half of it will be due at the end of 2021, and half of it will be due at the end of 2022. In essence, it's a short-term loan. I myself am not a big fan of not paying payroll taxes, just because if you get in a situation where you can't make the payments, the penalties are huge. So I would just be careful if you want to go down that road when you go through and make sure that it makes sense for you. But it can be a loan if that's how you're able to treat it. You want to go to the next slide? And this is kind of what we had kind of alluded to a little bit earlier, that the bill allows you can still use the 8-week period if that makes sense to you. And really, when I've been talking to people, if you want to go ahead and apply for forgiveness now, and the bank's taking those applications, go ahead and do it. But I am recommending for people that think it's what I call slam dunk, right? You're either, for some reason, your business is better than last year, you have more employees, you never laid anybody off, you have plenty of expenses, and you can easily get to that. I think it makes sense. Now, if you're aggressive on maybe what you categorize as expenses and you're not sure, I'm not sure if going to the bank and having the bank or somebody or the SBA tell you, no, that's not an allowable expense, and now all of a sudden you've got a loan, that if you would have waited the 24 weeks, and that's kind of earlier when I was suggesting, I don't know if I'd be in a rush to go ahead and apply unless, again, it was a slam dunk. I had another client that I was talking to, and they were over the $2 million mark, so they're subject to the SBA audit. They were going to be in a rush to apply and for forgiveness. And my comment to them was, well, if you want to say you had economic uncertainty, does it really make sense to be the first one there and have it done in 8 weeks? And I said, also, do you want to be the first one going through an SBA audit when this happens? So they're just going to, probably take their time as far as when they go through and do it, that type of stuff. Again, you can see which one is better for you. And if the 24-week period is elected, one thing you want to consider is the timing of forgiveness for your year-end tax returns and financial statements. So one of the things is if you end up at the end of the year, and let's just say you have to get your financial statements done quickly after the end of the year, and number one, if you're subject to the SBA, but the bank does need 60 days to get through the application process when you go for loan forgiveness, and if you go to the SBA, you're not 100% sure when you're going to get that information back, and that could possibly delay, your financial statements. They get prepared. So just something to keep in mind. It could be a timing issue. And then the other thing is, and we're actually starting to see this on some people that have fiscal year ends right now, is that as of right now with the tax situation, the loan forgiveness piece is not taxable, but also the expenses associated with that are not deductible the way it reads right now. Now there's, people are trying to get that changed, and hopefully that does get changed. But as of right now, if you're a June 30th year end, the way the rules were right now, you probably don't want to hurry up and file your tax return until that gets settled down. So just some things to keep in mind, that it may just mess with some of the timing of some of the things at the end of the year. Go to the next slide. This is kind of summary, kind of what Larry and I have been talking about as we're going through. And this is just kind of a chart that kind of goes through everything. The change in the covered period, the max wages, and you'll see there's some footnotes there with some of that stuff that just, some of the stuff we are assuming that's what's going to happen, especially the max wages that may end up getting changed when we go through it. But again, this is just meant to be a summary. And so when people go download the slides, you'll have this later on. Go to the next one. And then actually, it looks like, there it is, Jerry. Hey. I can't remember if we're going to do this. Well, let me do the conclusion real quick, and then go to the next one. And then Jerry and I are going to talk about the Main Street Lending Program. So, as Larry mentioned earlier, and again, it's not going to be the last time you hear this, we're just waiting on continued guidance. There's going to be plenty more that comes out to kind of clarify things and that type of stuff. So we're expecting that stuff to come up over in the near future. There was a HEROES Act passed in mid-May in the House. It doesn't look like it's going anywhere in the Senate. I saw something today that the HEROES Act in the House was about a $3 trillion bill. The one that the Senate's working on right now is closer to $1 trillion, and the administration wants to do something in the $2 trillion area. So this is stuff that might be additional stimulus checks. They're talking about opening up student loan forgiveness a little bit, some mortgage relief, those types of things. And I know the Senate bill also gets into some other things such as, protection for some owners of businesses with some liability and some of this stuff. So again, we're just gonna be a wait and see there. And so we just say, stay tuned. So Jared, do you want to maybe, the reason we don't have a slide for this is just some of the stuff just came out yesterday and today on the Main Street lending, but Jared, you just want to touch base on it and I'll chime in if it makes sense?
Sure, thank you. Main Street Lending Program, the program really coming from the Treasury. It's, I think, a $600 billion loan fund that really is more upstream from the PPP process. Again, the PPP program provided loans of as little as a couple $1,000 for people. This is really designed to go at least, I think, $250,000 up to almost 25 million. So larger program. It is a loan program. It has a 4-year window for the amortization. There are restrictions on things like distributions and other expenses that are paid. So you have to kind of watch the requirements in the program. But it is another program that's becoming available. You can look into, how it might work within your needs and how it works in combination with possibly the PPP program. But yeah, again, it's another large program that's coming online with a different set of requirements and restrictions. So all of those need to be kind of factored into your plans going forward. One of the things that it does lock down future repayments on other debt. It will compromise what the bank can do in conjunction with this type of a loan. So you've got to be careful of understanding how or what kind of requirements the loan has with it if you used to pursue it. I don't know if there's anything else, Ray, that you want to touch on?
Yeah, I'll just touch on a couple of things. So it's my understanding that this is something you're actually going to go through your bank as far as an application process, so kind of like the PPP loans when you went through your bank.
Yes. It starts with the bank, so you need to talk with your banker or your bank about starting the application process. The Treasury actually buys back up to, I believe, 15% of the loan, but the portion does stay with the bank. So again, this is not meant to be foreign. It is a loan, but part of the loan is actually bought back by the U.S. Treasury.
Yeah. And I think the minimum size is 250,000. That just changed in the last couple of days, and you can borrow up to, I forget what the was, but I guess it's a lot more.
25 million is my understanding.
Yeah, 25. Yeah, I think you're right. I think it is 25 million. So obviously, it's there anywhere in the middle there. It's meant for businesses with less than 15,000 employees, less than 5 billion in revenue. The interest rate is LIBOR +3, so it's a pretty good interest rate on it. And the first two, it's based upon your 2019 EBITDA. And there's different categories in here as far as what you use the loan for, but it's based upon your 2019 EBITDA, so determines how much you can borrow. And trying to think if there's anything else I wanted to say.
The first year the loan is a peanut deferral. The amortization then really kicks in years 2, 3, and 4. So it's varied on terms of debt service in the first year, but then it gets built in the last 3 years of the 4-year loan.
Yeah, and this is something you can do if you got the PPP loan. So it's not one's not exclusive of the other. So I think it's definitely something people should take a chance to look at, and you can use it to refinance other debt too. All right, so if we want to go ahead and Jerry, did you have anything else or?
No, I think that covers it. Thanks.
No, thank you. And if you want to head over to, I think Larry's got the next slide.
All right, so I want to thank the participants for sending questions in advance. We looked through what we got in advance and tried to pull out some of the questions that we were seeing the most of that had relatively quick answers. So we're going to move through a quick lightning round of questions there, and then we're going to hope that Dan can help us out, and we'll maybe help ourselves out by surveying what's come in for, we've got a whole bunch of Q&As come in during the session, and so we'll use the remaining time to try to get to those.
Hey, before we get to Larry and Dan, do you want me to read through them just because it might be easier for me to sort through what we've answered already?
Yeah, you can read through
sure,
the ones that were just submitted.
Yeah, absolutely. Yep.
Sure. Thanks, Ray.
Mm-hmm.
So can I choose a period in between 8 and 24 weeks? Yes and no. I mean, you either choose 8 weeks or 24. So it's an either or. But you don't have to spend the money over the 24-week period. You spend it over whatever period of time is comfortable within that period of time.
So Larry, let's say you're past the 8 weeks and you're done in 10 weeks. You got to apply for the 24 weeks. You can't do it in 10 weeks.
Well, once you go once you spend beyond 8 weeks, you've committed yourself to the 24-week option, which at a minimum right now means that what was June 30th in terms of having to get your forgiveness employee count and payroll levels restored becomes December 31st. But again, we're hoping that there's some date in between then, because it seems like a rather long time to have to wait. I should point out that if let's say, if you're 8 weeks and you're done and on June 30th, your levels are back up to where they were on February 15th. That's great. You aren't obligated on July 1st to maintain them at that point. The government would prefer that you do, but there's no obligation to do that. If you move over to the 24-week period, and let's say December 31st stands as the date when you have to have levels restored, in between then or now and then, it's entirely possible and probable that folks will come and go, that needs will change, and so that levels will go down. It's really a question of restoring them by the evaluation date. And so, folks have asked us, well, what if some folks might want to go on unemployment? Is that a problem? It doesn't really have any impact. You're spending on what you're able to spend on. If then you have to make other business decisions between now and then. But you will, if you want maximum forgiveness, need to be restored by December 31st, or as I say, an earlier date if they allow that option. So we answered this one already. Does a 24-week period require an opt-in? It does not. Not a formal opt-in, nothing that the SBA has to see. But again, if you continue spending money after your 8-week period, you will have chosen the 24-week period. Can I reapply for more money? There's been a little split in the guidance on this. There were different periods of time if your application was in, but you hadn't gotten your proceeds and you wanted to modify and beef up what you were asking for, that you could get more money. It's our general understanding that you cannot. Whenever you got your 2.5 times or whatever the number was, once proceeds have been dispersed in the first instance, then you're locked in and that's the amount of the loan that you can get. I will point out that new folks who are applying who applied after June 5th or are now after this webinar deciding to take the plunge because they haven't been in yet, they'll have the benefit of all the guidance that's issued. So they have a better feel for what they can spend the money on, and they may be a little more, regressive is probably not the right term, but might feel more comfortable about including a larger category of expenses because they don't have to worry about spending it in the 8-week period. They've got a longer period of time to spend it. So in a sense, they'll be able to get theoretically more money. But again, that's for a brand new loan. Is the forgiveness, if my money is all spent, when can I apply for forgiveness? This is what we've been talking about. There's some go ahead. Oh, I thought someone had. There's definitely some strategy involved here. A lot of folks thought originally when it was 8 weeks and that's what everyone was going to be on was one schedule, that you probably wanted to get in just as quickly as possible because as surely as there was a run on the banks to get the money, there's going to be a run on the banks to get forgiveness. Now that folks are going to be spread out over a longer period of time, and undoubtedly a lot of folks, their 8 weeks came and went before the Flexibility Act came into existence. So there's certainly going to be an early cohort of folks that do apply for forgiveness. And we'll watch what happens with them, and we'll see the process get refined. So of course, as we pointed out here, they're not obligated to file for forgiveness right away. They still have up to 10 months to make that application. But in any event, there'll be a track record, so we'll see how folks are doing. My general advice to folks would be, as with Ray's, it's probably wiser to wait a bit and let the process sort itself out a little more so you have a better idea of where you're going to be and you're not in some kind of traffic jam.
Hey, Larry, can I just touch base on that real quick? So I've had a lot of people ask or think that the bank is going to reach out to them for applying for forgiveness, like it's almost like it's the bank's responsibility to make sure it gets done. And I've seen a lot of communication from banks. I think they're doing a great job communicating, but I think ultimately responsibility for forgiveness application is going to be the borrowers in order to go through that. So for some reason, you're not getting that good communication and you're waiting for somebody to reach out to start that process. I think you just need to make sure you're on top of it. Again, you can wait, kind of like Larry was just saying, and it might be a good strategy. It's just at one point, it is your responsibility to make sure it gets done.
I would tell you that most banks are trying to communicate as best as possible. as they understand the program. But they're also trying to set up, not really all that clear. We're hoping they'll open up the forgiveness, and we'll be communicating with our clients, and that process will start and how it will work. But after that, I think with any new process, there'll be some bugs to work out. So not rushing in is probably smart.
Thank you, Jerry. So is the forgiveness taxable? We've been over this in prior webinars. In general, debt forgiveness or cancellation of indebtedness would be taxable, but for the CARES Act exception to that rule. So it will not be treated as gross income, and it will not be treated as gross income. And that's a good thing. As Jerry mentioned before, whether the expenses are deductible that you've spent it on is a separate question. And for the time being, the IRS has said that they're not, or at least most of the main categories of expenses are not. How long do I have to maintain my FTE count under the 24-week period? We've talked about this. It's not a question, again, it's not a question of keeping it at that level. It's a question of restoring it to that level at that point in time, or at the, so by December 31st, or as I say, possibly earlier. But in between, you're free to do with your business as you please, and then you'll take your chances in terms of whether strategically you're able to get things up to a level where you're able to get the type of level of forgiveness that you're actually looking for. So we had a question about whether the SBA has issued new forms and instructions for forgiveness. They haven't. They've issued a new borrower application form and a new lender form to recognize the Flexibility Act's 24-week time period, covered period. So that's out there. They have started conforming the old interim final rules to meet the Flexibility Act's 24-week period and the other components of the Act. So they undoubtedly will modify the forgiveness application, and this probably goes to that 30 FAQs on hold type of concept that we were talking about before. I presume that they'll be, well, that this is obvious. They have no choice, obviously, but to change that. It's not, from what they've done so far in terms of the application and stuff, it's not as if there's going to be a substantial change based on the Flexibility Act, but it'll be changes just to conform to the new terms of the Act. And then we've had a lot of questions about EIDL, sort of the intersection of the EIDL loans and the PPP loans and how that might impact forgiveness. So essentially, you find yourself in a couple different categories. If you did receive an EIDL loan before a PPP loan, so that would mean an EIDL loan from January 31st of this year through April 3rd of this year, and it was not used for payroll costs, then it doesn't have any impact on the PPP eligibility. If you did use it for payroll costs, and again, you had to have gotten the EIDL before April 3rd, then whatever you applied for the PPP, you were required to roll the EIDL into the PPP, at least the payroll portion. But that also was a way essentially of increasing what you could get under the PPP, because let's say you applied for 2.5 times. So you get the 2.5 times your average monthly payroll for the PPP. And if you'd spend some money before that on payroll, then as I say, you'd roll that in. So you'd wind up with a larger PPP loan and therefore a larger portion that could be available for forgiveness. But for any portion that isn't, you've got a shorter term, but a lower interest rate to pay it off. So anyway, so there's that category of folks. And then there's a separate category of folks who got an EIDL loan after the 3rd of April, or in any event, well, after the 3rd of April, and after they, or I guess whether after they received a PPP loan. So for those folks, as you are not required. Number one, you're not required to roll that into the EIDL. You don't have to refi. You don't have to refi the EIDL rather into the PPP. And as long as you don't spend, as long as you don't double count and spend the EIDL proceeds on the exact same expenses that you're using for the PPP, but you can certainly spend them on similar expenses, but not the same expenses. So if you were able to cover 2.5 months worth of payroll with the PPP, and the EIDL gave you the ability to cover a few more months worth of that, some working capital and otherwise, then you've just got two different loan facilities, with one being potentially fully forgivable and one available for up to 30 years. Is it 20 or 30, Ray? Sorry, because it's
30 years
Your mortgage.
30 years, yeah.
30, right. At 3.75 if you're a for-profit, or 2.75 if you're a nonprofit. And then the one category that will impact forgiveness is this up to $10,000 grant that folks got through the EIDL, so the first advance under the EIDL. And it's a little confusing because even if you got that cash advance but never applied for the EIDL, or got it and applied and didn't get an EIDL loan, they weren't requiring that you give that money back. So it was essentially a grant. It is a grant, but that up to $10,000 will count against your PPP forgiveness, which seems equitable. So hopefully I haven't made that more confusing than not. Essentially, if you had an EIDL loan before a certain date and spent it on payroll, it had to get rolled into the PPP, and you would have accounted for that on your application. If you have one afterwards, it can be a standalone, and you can have both the PPP and the EIDL as companion obligations. A couple other things that I saw in the questions, and then we'll just go to some more general questions. Folks wanted to know if the 60/40 rule applies to everyone now, or if there are folks that still would be covered by the 75/25 rule. Ray, what do you? I mean, I was going to say yes, it is the new rule, but clearly, if you're under the 8-week period and you don't want to jump into the new, I guess I'm not sure whether you could take advantage of it.
I think the 60/40, you can still take it under the
Right.
period. So yeah, I think you can do that.
Right. So, and then really there's a decision that you have to make. If I'm payroll heavy, then the 60/40 rule doesn't really help me that much. If I'm rent heavy or utility heavy, then it does help you, because if you're, say, a restaurant, you didn't have a lot of staff, but every month you had to make your rent payment, then this gives you the flexibility to spend more on the non-payroll side, and therefore, as I say, get closer to attaining full forgivability. So someone asked the question, can 100% of the money go to payroll? Yes, it can. So that's our.
Before we move to the questions, Ray, that you probably have found, I have a question about the EIDL as a business owner. And Jerry, maybe you can add to this as well. Is an IEDL, is it a advantage to, is it an attractive option for a business owner over a traditional commercial loan from a bank? Because it's through the SBA.
I'm sorry.
Because
We haven't seen a lot of usage of the EIDL loan. Nowhere near that, obviously, the volumes on the PPP loan. So I think most people are finding that the restrictions and the requirements that come along with the 30-year amortization is a little complicated, maybe a little onerous. And so most have opted for either deferral programs or other loans that are more conventional.
Great, thanks. Ray, did you find some good questions in there?
Yeah, I think we're up to about 120 now, so we're going to be. So I think some of we have talked about a little bit. So I'll just start reading them off. So as part of our routine process of paying our employees, we schedule semi-annual bonuses, wages scheduled for the end of quarter 2. These bonuses throughout the year were factored in the PPP loan amounts, their 2019 payroll. Our bonuses, so as long as they are under the the $15,000 threshold, permissible towards forgiveness amount. And I can go ahead and take that one. So the answer would be yes. They're still there. As long I would just make sure you pay them during the cover period, just to make sure you're taken care of there. But yeah, you can go ahead and pay bonuses. Again, and you're subject to that cap.
I have one that was interesting. If you submit for 100% loan forgiveness based on 8 weeks, but it's rejected, can you change your application to 24 weeks?
I don't know the answer to that.
There is a 30-day appeal or review process that comes about if you choose to debate the forgiveness decision. So I would imagine within that 30-day appeal process, you could try to opt between the 8 and 24-week period.
And this may be one of those things too, if you wait, there may be more guidance on this that comes out later. And also, I think I mentioned earlier, if you think you're being aggressive about any expenses, it might be a reason to wait or opt into the 24-week versus the 8-week when you do it. So as you can imagine, we've gotten some pretty interesting questions over the last few months on what qualifies. Next one is when we applied for the PPP loan, under the number of employees, we didn't understand, basically says we didn't understand the full-time equivalent. Is that going to cause any issues for me in the future, and how do I get that corrected? So, yeah, I can take that one too. So I think the number on the application was more of an informational thing. When you get it, I don't know, but I'm assuming if you can prove that that number wasn't correct and you can show this is what my full-time equivalent was during the base period, that you'll be fine. So I don't think I'd be too worried about the number you put on the application, because that didn't change your loan amount, and it's probably more informational than anything when you went through. Let me answer that. This one's kind of interesting. So is there any way that a seemingly ostentatious action like a large distribution paid to owners could affect forgiveness?
Yeah, I think Dan can answer that question.
I would think so. I would think a red flag would go up. I mean, is there a limit to what owners can take?
Well, the distribution wouldn't actually be wouldn't be an expense you could use for PPP forgiveness anyway.
But
now,
some are paid via distribution, not W-2.
Yeah, but still, you're limited to the lower of $100,000.
Right. Yeah, that's what.
So you really don't have. I mean, it's easy for me to say, but you really don't have a lot of room to mess with that. So
yeah,
one of the things we had a conversation with some of our clients about was that if you're in a situation where you have economic uncertainty and you're trying to prove that you needed the money, taking out large distributions is not going to help your argument in that case. When you go through, if you really needed the money, why would you be taking the money out? So that's something to be careful with. And that'd probably be more of my concern. Are they going to come back later and say you didn't need the loan because you took out a large distribution? I don't think it really has any impact on the forgiveness piece.
So it's more an eligibility question then, basically.
Yeah.
Has the 8-week period in which loan forgiveness extended, or is it that you can now choose any 8-week period within the new debt, within the new deal? Has the 8-week?
That's the basic distinction between whether it's if you either choose the original 8 weeks or you choose the new 24 weeks, of which the first 8 counts as the first 8 weeks.
Yeah.
So you'll still have 16 more.
Yeah, the only leeway you're going to have in there is when I mentioned the alternative payroll period that's going to start. You can use it to start with the first pay that starts after your covered period starts. So that's the only, I think, leeway you really have in that right now. How do I handle utility expenses if I'm on the budget plan? I think it just gets back to paid or incurred when you go through it. So if that's what you were billed and that's what you paid, then I think that's what you're kind of stuck with as far as that.
Jerry, I have a question. As businesses move forward, how can they work with their bank to help them regain their momentum? So they've gotten through this period. Now they're moving forward. They're looking beyond COVID-19, even though we're not beyond it. The business has to look beyond it to get back up to speed. How do they work with their bank?
Yeah, every business has been affected differently, and the rebound or the repair is going to come at different paces. So when talking with your banker, it's always important to just communicate your current situation, and as best as possible, try to communicate where the company is going in your best opinion. So, any guidance you can give the bank or banker in terms of where you feel impact will be going forward and what kind of a need you have because of that. That gives the banker an understanding of what to bring to the table, whether it's the AIDL loans, the deferrals, new lines of credit, term loans, all of that comes into play. But having a really good understanding of how much impact there's been and how much future impact there's going to be is really the starting point for any bank or banker to try to create a solution that works.
Safe to say that a banker doesn't like too many surprises.
Absolutely.
That's a very safe bet. But we know this is unprecedented times. The 2008, 2009 period was different. We knew that was the start of a kind of a big and fairly long recession. We don't know about this situation, whether it's a quick bounce back or it's more of a long U. So we're all trying to ascertain where things go from here. And as at least commercial clients have needs beyond the PPP program, the discussion will really center around where to.
We lost you again. So, Ray, do you have other questions?
What do you think the needs is? What program loans might be?
All right, Ray.
Yeah, go ahead. So the next one I was actually going to give to Jerry, so I don't know, see if he comes back or not. This was kind of an odd one for me. So our bank is already charging interest. Is that correct? They have said we will have to pay interest on the funds we do not return starting from that date we receive the grant. Is that correct?
I'm sorry, can you reread that?
It says our bank is already charging interest. Is that correct? They have said we will have to pay interest on any funds we do not return starting from the date we receive the grant. Is that correct?
There's an assessment of interest yet, as I understand it, and it's the way we've handled it. I think that's all deferred until the forgiveness decision has been made. So actual charging of interest via payments shouldn't be happening at this point.
Yeah, because that was an odd one. I haven't heard of anybody getting charged interest.
I see an interesting question that I've actually wondered. I'm particularly interested in how the FTE count is going to affect the amount forgiven and which period will be measured. So let's say I don't know how to do the math, but you drop one person. Is it in that one? Let's say you have 100 employees and you drop one person. Are you affected? Is the forgiveness affected by 1%? Is it an equivalent amount like that? Or is it because you have one less full-time employee?
Yeah, I guess go ahead and take that. So if everybody's a full-time equivalent, and that's and the 1% is on your forgivable expenses. So if you get a $300,000 loan and you run up $300,000 worth of forgivable expenses, and let's just say the 8-week period, and you're down one person, one full-time equivalent out of 100, then yeah, it'd be a 1% decrease that you would have on that. We go through. So the interesting thing on that too is that if with the 24-week process or the 24-week period, if the loan application doesn't change, the way that it reads right now is that 1% would be taken off of the expenses that you incur in that 24-week period. So the example I've been using is, just say you get a $300,000 loan during the 24-week period, you'd run up $400,000 worth of expenses. You're going to, just say you have a 20% reduction in full-time equivalents. The 20% goes against a $400,000, so you still have $320,000 of eligible expenses on a $300,000 loan, meaning you're going to get full forgiveness. So the way that it reads now, and you do the 24-week period, there's room to have a decrease in your full-time equivalents. Now, we know they're going to redo the application for the 24-week period. We're just not sure if that aspect's going to get changed in it or not. But yeah, the full-time equivalent ratio does go against the expenses that you've accumulated. So.
Transportation costs, mobile phone bills, interest other than mortgage, what's included? I mean, those might be questions for people that are applying for it now or looking to fill out their worksheet to determine what they can include in the non-payroll expenses.
So we've been including cell phones Some people include cell phone in their expenses. I think the transportation costs I mentioned a little bit earlier is fuel costs that go into that. And then what was the third thing that was listed?
Mortgage, interest other than mortgage.
So then I think I mentioned that a little bit earlier. It's where there's a little bit of conflicting guidance on it, I guess, or way people are interpreting it might be a better word. We're seeing people say that as long as it is backed by real estate or fixed assets, that it should be eligible. And the other extreme is it's actually got to be like a loan on your real estate. And that, I can just say that's something we're just waiting on further guidance for in order to interpret what to do.
I have another one. We're realtors and commissions paid are on 1099, not W-2. Is this included in payroll? They included it for the loan.
Well, early on in the process, when it first came out, they did say 1099s were eligible, but that got changed. And I think there were some banks that still allowed it. And I think it was just a timing issue and when it went through. So they probably got a larger loan than they should have when they went through it. But the 1099s on the forgiveness side are not includable. It's got to be W-2 type income. Because the idea is the person getting the 1099 could go get their own PPP loan.
Mm-hmm. Ray, what other kind of questions do you have up there?
Actually, just move it.
I had a question. Folks wanted to know just a little refresher on the difference between eligibility and forgiveness. We've been talking a lot about forgiveness, but I mentioned eligibility before. This goes back to the days of the original safe harbors of giving the money back if you didn't think that I guess the certification of necessity that you were required to make on the loan application, and how folks got all scared that in the post Shake Shack era and that sort of stuff that they should give the money back. And so people did revisit and memorialize their necessity determination from the start. So there are some different thresholds. 2 million and up, you're still, from an eligibility perspective, your eligibility is going to be looked at, or at least you're supposedly going to be audited by the SBA. What that means, again, we're not sure. In any event, they have the right to look into the basis of your claim of necessity for the loan. Under 2 million, they moved around on this for a while, but now essentially they're deeming any of those loans to be necessary and taken in good faith. So the underlying basis, with a limited exception, is not going to be looked at. So that goes straight to eligibility. And in the event that there is a determination that you weren't eligible, then you're going to be required to pay back the loan, if not immediately, quickly. I mean, that means flat out pay it out. Not a question of forgiveness doesn't apply. You don't even have the right for the loan to be considered forgivable. It just becomes due.
All right, there are a bunch of questions in the chat. Are all union benefits able to be used for the PPP, or only health, welfare, and pension?
I think that's something we're still waiting for guidance, but we've been telling people it's just the health, welfare, and pension type stuff. Include it. We got one that says, can you include temporary help costs and salary calculation for forgiveness? We've seen that actually get turned down. So they actually came out, leased employees are allowed as long as you can segregate their payroll. But on the temporary side, we're not seeing that's being allowed at this point.
Somebody asked, is there any talk that the PPP loans under 150,000 will be forgiven entirely by the SBA without regard to all the calculations discussed today?
I've seen some discussion of that, but there's nothing formal yet.
I think this was confirmed. The PPP can be used 100% for payroll. I think, Ray, you confirmed that.
For owners of an LLC with employees, is the owner's compensation treated as the same as the sole proprietor? The answer is yes, depending on the type of LLC. I don't know if they file as a Schedule C or as a partnership. If it's a partnership and they have guaranteed payments, it's what's subject to self-employment tax is what you're including in that number that the owner has when you do it. So, but the answer is yes, but you just need to make sure the income's subject to self-employment.
As part of our routine process of paying for, our employees, we schedule semi-annual bonus wages scheduled for the end of Q2. These bonuses throughout the year were factored in for the PPP loan amount calculation of our 2019 payroll. Our bonus payments, so long as they're under the threshold of the $15,384 per employee, permissible towards the forgiveness amount.
I'm sorry, I was reading another question. I didn't.
For bonuses that were planned from 2019, 2020, and Q2, are they eligible, permissible for forgiveness?
Yeah, I think as long as it's in your covered period and you're subjecting everybody's limit to the
15,384
or the 46,000, whatever the number might be.
Yeah.
Question is, are lease costs for machinery included as non-payroll costs? Yes, as long as you're leasing the machine, as long as it's a true lease. So if you have a financial statement and it's being treated as an operating lease, the answer is yes. If it's capital lease, that's actually treated like you bought it and it's debt. So if you're showing a loan, even though it's called a lease, then that's not considered rent for this reason.
So I have a 401k related question. We have a 401k profit sharing plan and made our 2019 employer contribution 3% safe harbor plus ER discretionary contribution during our 24-week period. Can we include that full 2019 employer contribution number in the calculation of forgiven employee benefits? That's the first question. And then can we include the 2020 employer safe harbor contribution incurred during our 8-week or 24-week period? 401k and profit sharing. Did you get that?
Yeah, I get it. So this is one of those questions where, you might be better off going with the 24-week period if you're getting down to this type of stuff. I haven't seen anything that says, no, you can't do it. Like I said, they changed it to kind of paid or incurred during the period. So you keep in mind, I'm not the one approving your loan application at the end of the day. But I mean, I can see putting that down, but I could also see somebody at one point saying maybe it's a little bit aggressive going through. But obviously, if it's something, if you prorated the 2020 contribution and paid that in, I think that would be an easy yes type of thing. But as far as paying 2019 and 2020, I think it would work, but I don't think it's I don't know if I have 100% comfort level that that's there yet.
If somebody's injured on the job, but hasn't worked in a few weeks, how will that be treated as an FTE if you're filing and didn't replace that person? Is it okay because they're injured?
I don't know if I've heard that one. I'm thinking about the exemptions that Larry was talking about earlier.
Right.
And I'm not sure if that falls in there or not. Are they going to continue to pay the person while part of it might be if they continue to pay the person while they're injured.
I would assume so. So that
Yeah.
I would imagine that they're still considered.
Yeah.
It didn't say. Well, we probably have, that's probably time. We could be on for another couple hours with all the questions.
Yeah.
But hopefully we got to more of them this time. Are there any last comments? Maybe, more guidance to come. If you could maybe identify what you think the big answers might be with that guidance and when you think that might be coming so people can plan for it and look out for it. That might be an interesting, one of your last parting comments.
I'll go and put my 2 cents in. Who knows when they're going to come out? Hopefully it's going to be relatively soon that they come out with more guidance. I truly think that one of the things hopefully they come out with is this being able to apply between doing some sort of prorated between the 8 weeks and the 24-week period. I think it's very obvious, most companies needed more than 8 weeks in order to get through this. And, if we wait till the end of the 24 weeks, end of the period, we're going to be running into year-end issues and not maybe knowing all the information at that point. Plus, it's going to be a drain on the banks. It's going to be a push on the banks that I don't think is really necessary when they go through that process. So that's kind of the one thing I'm hoping that comes out of this is that there's some leeway. You can do something between 8 and 24 weeks. We'll see.
Larry, Jerry, anything?
Well, I think Ray took pretty much the one that I was looking at as well. I mean, we really want to know how long you have to maintain your FTE or salary levels, or when they have to be restored by, if it's going to be December 31st, or if it's going to be some earlier date. So it's really the flip side of the same question.
Sounds great. Jerry, you got the last word.
Sorry about that. I was breaking up. I think it's just looking for guidance just so we can get the process started for people. So as this process has gone, information comes to us late, and the process is a quick start, and it's usually a little rough because of that. So we're looking for the guidance just to get some more clarification to everybody in the process of applying, to get the first applications going, and kind of learn from there.
Sounds great. Well, everybody, this concludes Webcast. Thank you to our presenters, Larry Glussman with Davis and Kuelthau, Jerry Schlitz with First Midwest Bank, and Ray Lampner with Sikich. These are your experts, and these gentlemen are available as a resource. You'll find their contact information on the slides. So I encourage you to contact with them, as they are a resource. So as you work through this PPP program. So as I mentioned, the slide deck's available online. When you exit today's webcast, a new tab will open in your browser with a survey. If you can please do that as we look to put together additional webcasts that are similar or different, that are things that you're looking to learn more about. So on behalf of BT360 and BizTimes, thanks again, everyone, for attending this webcast. Have a great rest of the day and a great rest of the week. Thank you. Thanks, guys.
Thank you.
Thanks, Dan.